Good evening, everybody. Hope everybody's having a nice spring evening. Again, we have the great pleasure of having Mark Dannenberg with us tonight. Mark has well over 30 years of trading in the market experience, and he works with a lot of traders in learning the art of trading. Because there are so many different strategies out there, kind of specializes in how to focus on the basic or specific strategies, I guess, and the necessary steps to take to kind of get consistent returns so you can grow a small account into a big account. So without too much more, Mark, welcome to the Candlestick Forum. We're anxious to see your information tonight.
All right, Steve, thank you very much for having me here. And thank you to everyone who is spending part of their evening with me. I'm going to be talking this evening about the art of trading, how to simplify your trading and grow bigger profits. I'm a firm believer that there are a lot of ways to complicate your trading that aren't necessary, and a lot of traders who have been trading for a long time want to push the reset button and find a way to just simplify things, almost kind of reset themselves. They have a lot of knowledge, but they don't have a lot of success. And then there are a lot of people out there who want to figure out how to start trading and learn how to do that successfully. So I'm going to talk to you a little bit about options trading tonight and some ways that I think people can get started if you've never traded options. And if you have traded options and you want to try to simplify things, that's a lot about what I'm going to talk about. As Steve mentioned, I've been trading personally for over 30 years. Now, I had a corporate career for about 26 years, and during that time, about 20 years of that, I was trading as a hobby. I loved trading. I learned a lot about trading futures, commodities, stocks, and options, and then for the last 10 years or so, I've been teaching other people how to successfully trade options. That's my passion. That's where I spend my attention and my focus. And I realized that when I was in my corporate job, that although I was fortunate enough to have a job that I truly loved, I looked forward to doing what I did every day. At some point, I would want to have a little bit more freedom from that, the requirement of the meetings and the travel and always having to be accountable to somebody else. And I realized early on that trading was something that would allow me to build a life of lifestyle freedom and also financial freedom. And so that's why I enjoy passing along my knowledge to other people today. I am a very active trader. I'm not just an educator. I'm an active trader in the markets every day. I actually, along with my trading team, host a live trading room every day. We are actively involved in opening and closing positions almost every single day and working with our community of traders to coach them on the skills and strategies that we use. So we teach new traders and experienced active traders how to think like a trader. That's a key mantra for us. Is we don't want them to always be dependent on us. We want to teach them how to think about what they're doing and how to recognize the right choices to make in any situation. Now, as I've traded over the years, I've identified some very basic key success factors to winning consistently. And I do want to win consistently. Winning consistently doesn't mean we never have losses. It just means that overall we want to be growing our account. We want to be having a series of successful trades with some losing trades embedded in there, but overall we are growing. So those key success factors that I've identified for myself and also working with a large community of traders is, first of all, prepare a daily trading plan before the market opens. Far too many traders that I've encountered, and I've worked with thousands of traders over the years. I used to teach live seminars with 500, 600 people in the room, and then I've taught webinars for the last many, many years. But far too many of them that I speak with have no plan when the opening bell sounds. They're just going to go see what's going on, and they're going to try to figure it out. If you have a trading plan before the market opens, you're bound to be much more successful. Number one, you want to know what your total risk tolerance is. You never, ever, ever want to use the excuse that you can't trade or your account got blown up because you put too much risk in place. That is inexcusable and is not necessary. If you know before the market opens each day how much risk you are willing to allocate to that day's trading and what portion of your total risk tolerance that is, you should never be in a situation where you blow out your account, and far too many traders do that. So also we want you to know what your profit target is for the day. It's good to have a guideline of what you can realistically achieve each day. It helps you know how you're progressing towards your bigger goal. Each of us as traders should have a quarterly goal, an annual goal, something that we're really striving towards. If it's just kind of hit and miss and it's just open-ended, it doesn't really matter what our performance is at the end of the year because we didn't really have a guide as to how we were doing, and we have no measurement to determine whether or not we succeeded, hit our goal, met our goal, or fell a little short of our goal. So if you have a profit target goal each day, that's going to help you understand whether or not you are on pace to achieve your big goal. Knowing your profit target eliminates overtrading also, and answers a question that I'm surprised I'm asked frequently is, when is enough enough? When should I stop trading? When should I just continue trading? When should I continue to hold a trade for bigger profits? When do I cut my risk and take the profit off the table? All of that planning ahead of time will answer that question, when is enough enough? Because if you take a trade off the table today, that yes, there might be more opportunity in that movement, but you lock in, let's just say, $500 of profit on that trade, and you know that by taking that profit combined with the other profits you've taken that day, it actually will lead you to your ultimate annual or quarterly goal, then that is a sound decision to make. Not all opportunity that is in front of us should be taken by us. We should focus on taking the opportunity, locking it in as a guaranteed profit so that we know we're making progress towards our goal. I also suggest that you know what entry signals you're going to use when you start trading that day. Now the arrows here, the red arrows, are indicating what I'm going to focus on in my talk with you tonight. So what entry signals are you going to use today? Now you have a huge advantage working with the Bigelow community of traders because they are really experts in charting and entry signals and trends and identifying what direction a stock or the overall market might be moving. I'm going to talk about some very, very simple signals today, and it's specifically designed for people who may have not done a lot of charting in the past and are looking for a simple way just to look for an entry signal, but know what it is before you start trading that day. And then what strategy are you going to use to take advantage of an entry signal? Are you a long option trader where you're buying long calls and buying long puts? Are you a spread trader? What types of spreads are you trading? You don't want to be figuring that out in the midst of having a signal to take and trying to make all those decisions on the spot. You want to have a plan before the market opens. And then what actions are you going to take on existing positions? So when you come into the market each day, you may be carrying positions over from the prior day or days, and you want to have some idea of what actions you're looking to take on those positions on that day. So that's just kind of an overview for you. Those are the key success factors that I have found in my own personal trading as well as working with a very large number of traders over the years. So number one, trade a strategy you understand. You want to trade a strategy that is relatively simple, especially if you're starting out. But even if you're a more advanced trader, you know, simplicity is a more profitable approach to trading. Use a strategy that's profitable in any market. And I'm going to share with you one of my favorite strategies, one that we focus on, especially for our newer audience of traders. And it's a very flexible strategy where it can accomplish a lot by understanding just the core basic strategy. You want to use simple entry signals, especially when you're first learning, for consistent profits. I'm a big believer that you start with a simple foundation, and then as you have success and as you have an interest in learning more, you can expand your knowledge. It's kind of like going to college and taking 100 level courses before you take 200 level courses and 300 and 400 level and then graduate courses. You want to start somewhere where you can demonstrate a level of success and feel confident in what you're doing and then expand your knowledge. Again, you guys have a huge advantage being in the Bigelow community of traders because of the charting expertise that is offered there. I'm going to share with you just one very, very, very simple charting approach that we use in one of our programs tonight. And our mantra really is trade to learn first and then trade to earn. Far too many traders come to options trading thinking they're going to get rich right out of the gate, 30, 60, 90 days down the road. They're going to have a heck of a lot more money than they started with. And that is actually very realistic and possible, but not if you don't know what you're doing. So when you first start learning options trading or any type of trading, trade to learn first. Focus your attention on understanding what's happening and not so much on earning a lot of money and building a big portfolio, because that will come if you immerse yourself in the learning and a foundation of understanding what you're doing first. So as I mentioned, we want to choose a flexible strategy. We want to choose something that's going to work in a variety of markets. Whether the market's going up, market's going down, or it's flat, sideways, we want to have a core strategy that will help us take profits out of the market. We want to use simple entry signals, as I already mentioned, and I'm a big believer that trading 3 to 5 indexes or stocks on a regular basis will limit the complexity of your trading. Now, there are a lot of great tools out there in our industry, search engines to go out and scan the entire universe of optionable stocks and indexes and ETFs, and those are really great tools. What I'm saying is, if you become intimately familiar with a set of stocks and indexes, you're going to be more successful, because there are, in my experience, enough positions that you can create for most traders by limiting yourself to a core set here. I like to trade SPX, RET, and NDX. Those are the 3 major indexes, not to be confused with SPY, IWM, or the Qs. We don't trade the ETFs. We trade options on the cash-settled indexes, and it's some of our favorite trading in all levels of our programs. We also like to trade, one of my favorites is Priceline, PCLN, and another one which I have not shown up here is Intuitive Surgical, ISRG. But we have a list of about 6 stocks, and we have the 3 indexes that we trade. For our trading and my personal trading, and I'm a very active trader, I might open and close 10 positions in a day. That keeps me very busy. Those stocks and indexes keep me very busy. I don't need to be scouring the entire universe, different stocks and indexes that I've never traded before and I don't have a relationship with understanding. We look for a 10% profit target typically. I'm looking for 10% of my capital that is at risk in that trade. 10% of the capital I have at risk in that trade is a great sweet spot target for me to take a profit. I'm frequently leaving some profits on the table, leaving opportunity on the table. I'm frequently taking a profit just when the stock or index reverses, and if I hadn't taken the profit would have evaporated. So it's kind of a balance between that. And after years and years of doing this, a 10% profit is a very simple and easy target to focus on. And then that allows me to almost immediately recycle my capital into another new targeted trade, and that recycling of the capital is what allows you to grow your account and have what most people, outsiders looking in, consider exponential growth. That must mean you have huge amounts of risk. I am a huge fan of minimal risk and constantly recycling the same capital over and over again for big account growth. We like to keep it simple. We like to develop methods and work with strategies that create consistent profits for us. So I want to talk to you about a strategy that we work with every single day, and I consider it to be one of the best areas for any trader to focus their attention if they're looking for a way to simplify. Credit spreads are a simple directional strategy, but you're going to see here that the way we build credit spreads, if you have a good core understanding of the foundation of a credit spread, can be used in any market. There's a lot of flexibility, and I'm going to show that to you. So here's the really interesting thing about credit spreads. It's a simple strategy. It's one of the first spread strategies that most option traders will start focusing on. But a lot of traders fail at trading credit spreads. It's really not necessary for that to happen, but it does happen, and I've talked to hundreds of traders who have had many, many problems trading credit spreads and stumbled. And it boils down to three primary things in my conversations with those individuals. One is improper selection of strikes. When you are opening a credit spread, you are opening two different option legs, and the placement of those strikes is critical to the potential success of your position. I'm going to show you a very, very simple way that you can properly place your strikes. They also don't build enough time into the position. This became more of an issue when weekly option expirations were offered more and more and more a few years ago. And the perception of a lot of traders was I need to trade weeklies. Well, I personally always use weekly expirations, but I am not necessarily trading the near week. There's a very big difference in those two things. So when somebody says to me, do you trade weeklies? Answer is absolutely I do. What they're really asking me is, you trading the next week expiration or the nearest week expiration? And the answer is almost always no, I don't do that, but I do trade weeklies. But my weeklies that I'm trading might be 2 weeks out, 3 weeks out, 4 weeks out. And I'm going to show you some rules that we've built around proper construction of credit spreads that really increases the probability of your success. And then the third thing is they just put too much risk on. They don't even understand that they are not properly managing their risk. They need to manage, each trader needs to manage their risk. They need to understand what the total amount of capital they are willing to risk in the market is, and then they need to be placing a portion, a fraction of that total risk capital into each trade. Therefore, they should, by following good money management and good risk management, never put themselves in a situation where one, two, or a series of losing trades, if they have that, will put them in a situation where they are out of the game. It's not necessary. Too much risk creates a tremendous amount of fear and anxiety in traders, and once they get into that emotional state, they start making very, very poor decisions, which just compounds the problem. All right, so I'm going to talk specifically about credit spreads here. I'm going to talk about the 3 steps to entering a trade. Number 1, look at the chart. We need to determine whether or not there is a directional bias to the upside, directional bias to the downside, or whether there's a neutral bias. And the neutral bias is something we'll talk about in just a little bit. On a very, very simplistic chart basis, when we have people who start out with us trading options, we suggest that they start by focusing on 2 and 3 standard deviation Bollinger Bands using daily and 60-minute charts. I'm going to show you a couple of charts here in just a moment, and you're going to see what I'm talking about. The Bollinger Bands are a very reliable, simplistic technical indicator that allows almost anybody, even if they have never done any extensive charting before, to be successful choosing the entry for a credit spread position. Second thing is we're going to go to our options chain, and we're going to choose an expiration for our position that is 2 to 4 weeks out from today. So I'm trading weeklies, as I mentioned, but I'm going out 2 to 4 weeks and placing my expiration out there because I don't want to be in a situation where the market takes control of my position away from me. I want to be in control of my position at all times, and if I am in trouble on my position, I want to have time to be able to choose what type of management action I want to take on that position. I don't want to be jammed up against expiration. In fact, I rarely ever allow a position to run into expiration week. I'm going to take some action and maintain control of the position. And then the third thing is when we're opening a credit spread, we're creating a credit, we're bringing cash into our account. I'm looking typically for a credit of $1.20 to $1.80. Now there's a lot of experience and a lot of thought that goes into that range. That's a sweet spot that says we're far enough out of the money that typically we will be outside the range of movement of the stock or index that we're trading, and we're close enough to the money to have substantial enough credit that if we are in trouble, we've got some credit to work with, and we're not subjecting ourselves to an unnecessary level of risk. And we typically start each of our credit spread trades as a 5-point spread. Always, every trader is responsible for sizing the position, the number of contracts that you trade, based on your personal account size and your risk tolerance, and should never overextend your risk. All right, so here's an example of a credit spread. I want to get everybody on the same page in case you don't know really the details of a credit spread. If you do, then this will just be a refresher for you. But if you don't, this is a great opportunity for you to really understand the structure of a credit spread and several things that I'm going to point out here. So as an example, SPX, the S&P 500, was trading at 2360 during April week 1, and our chart analysis showed that there was a declining bias in SPX at that time. We wanted to take advantage of that declining bias by opening a call credit spread. In order to open a call credit spread, what we wanted to do was to sell to open April week 4, 2400 call. Sell to open April week 4, 2400 call. Now what that does is it creates what we refer to as a 40-point forgiveness factor. A 40-point forgiveness factor. What that means is we are going to construct a position here where we're selling to open a leg and buying to open a leg further away from the money. So the leg that we're selling to open, in our case the 2400 call, is what we refer to as the risk leg. So my risk factor here is that I want SPX to remain below 2400 between now and expiration, and I would like it to actually move lower, and I don't want to hold this position close to expiration. I truly would like to be out of it the next day for a profit. I'd like to recycle my capital as frequently as possible. But I've built time into the position by going out 3 weeks. I've built a forgiveness factor into the trade by placing my risk strike of 2400 40 points out of the money, which means that even though I see a declining bias, SPX could move up 40 points and I would still have a profitable trade. Now, I took $1.20 of credit on this by selling to open the 2400 and buying to open the 2405. The net of those two transactions was a credit of $1.20, so it fits right into my sweet spot of $1.20 to $1.80. The gross risk on this trade is $5. The difference between the strikes, which is 5-point difference, is always the maximum gross risk I have on the trade. That means that's the maximum gross loss I could have on the trade. But since I have $1.20 of credit, I don't ever have to give back that $1.20. I take that credit into my account, which means that my actual net risk is $3.80. It's the difference between the gross risk of 5 points and the net risk of $1.20. $3 and net credit, $3.80 of net risk. Now I'm going to choose the number of contracts I'm going to trade based on that net risk, and the number of contracts is going to be sized based on my comfort level with the amount of capital I want to put into this trade. As soon as I have this trade open, I'm going to place a good till canceled order to close for a 50-cent profit, which is actually 10% of the gross risk. Now, when we're trading credit spreads with a 5-point spread, that is the most common closing order that we will enter, a 50-cent profit. That's 10% of the gross risk. 5 points times 10% is 50-cent profit. If you're not a day trader and you have an account that you don't want to day trade, you would place that good till canceled order the following day. If you are a day trader, as soon as that position is open, you could go ahead and place your closing order, and if your assessment of the chart was correct and there is actually a decline coming, then that decline is actually going to decrease the value of the spread. You opened it originally for $1.20. We'd like to close it and buy back the spread for 70 cents. One of the most common questions I get at this point is, why wouldn't you just carry it to expiration? And the answer is very simple. Stocks and indexes cycle. They cycle up and they cycle down. Stocks and indexes that are trending, even in that uptrend or that downtrend, will cycle multiple times intraday. and I want to catch a cycle down, grab a profit, and perhaps when it cycles back up again, I may get right back into that same trade for another $1.20 of credit. I'm going to be more profitable by taking my 10% profit, 50-cent profit, 10% of gross risk. I'm going to be more profitable overall by harvesting that profit and taking it multiple times than waiting 3 weeks and carrying this position all the way to expiration. So this trade is set up to benefit from a move down, but it also has a forgiveness factor if instead SPX moves higher. Now I want to show you a real-time example here of a credit spread opportunity with a great Bollinger Band snap setup, and I'll explain that to you in just a minute. This is on ISRG, Intuitive Surgical. So here's the 1-year daily chart, very, very simple chart. All I have on this chart are Bollinger Bands, 2 and 3 standard deviation Bollinger Bands. The inner blue line on the upper and lower is the 2 standard deviation, and the outer blue line is the 3 standard deviation on the upper or lower. Now, our experience in the last 30 years, and I say mine plus one of my trading partners has as much experience as I do, our experience is that in general terms, when the price starts reaching or breaching the upper or lower Bollinger Band, there is an increased probability that the price will reverse. Increased probability, no guarantee, absolutely no certainty, but one of the things that we do know is that when there is a pattern where the price has moved outside the upper Bollinger Band, as it did yesterday, and as it did above the 2 standard deviation Bollinger Band today, there is a even more increased probability that the price will, at least near term, decrease back down inside the Bollinger Band envelope. So if I wanted to take a trade on this, I'm going to look for a risk strike that is outside this Bollinger Band range, and it's outside this long-term line of resistance, and I'm going to open up that trade, and I'm going to give myself enough time in that trade in case the stock continues to climb higher before it turns and moves lower. When I'm trading indexes, this Bollinger Band snap is one of the most profitable strategies that we trade in our live trading room. So let me just jump over to the options chain here, and we'll look real time. ISRG closed today at 814.45. I know that I want $1.20 to $1.80 of credit. So the first thing I do is I just go to the options chain. I actually find the first strike that gives me $1.20 to $1.80. So right here, if I sold to open the 835 and bought the 840, you can create a spread on that, a vertical spread. I'm going to sell the spread, and that would give me a credit of $1.30. Selling to open the 835, buying to open the 840. So the 835 is my risk strike. It gives me a 20-point, just a little over a 20-point forgiveness factor. And personally, I love that forgiveness factor because we're coming off of a Bollinger Band snap, and yesterday was a new all-time high for ISRG. My personal experience is when I have a Bollinger Band snap combined with a new all-time high, I will jump at an opportunity to take a trade on that position as a counter trend trade, because ISRG may continue to trend higher, but at some point it's going to retrace lower before it moves higher, at least based on prior experience. In this case, it could move another 20 points higher and we would still have a profitable trade. By the way, I'm choosing May monthly expiration for this. That's 1 month, 4 weeks away. So I'm giving myself plenty of time on this trade. That is an example of how to simply look at the chart and choose a trade based on the Bollinger Bands. So let's go back to our credit spread concept. Iron condors use the same basic understanding of credit spreads. Now the cool thing is that an iron condor is used to create a non-directional position. but the foundation of an iron condor is still a credit spread. So if you gain a mastery of credit spreads, then you will also be able to trade non-directional positions in flat and non-trending markets. The way you create an iron condor using credit spreads is you open both a call credit spread and a put credit spread at exactly the same time. Now you can leg into one side or the other, but let's just assume you open them both at the same time because you don't see a real strong indication of a movement higher or a movement lower. That may typically keep you out of a position if you're just trading a directional bias, but now you've got an opportunity to perhaps trade a non-directional bias and make a profit on both sides of the iron condor. You're going to use Bollinger Bands as a guide to choose the strikes. And here's the cool thing on an iron condor, because one of the positions is a declining bias, that's the call credit spread, and the other side is a rising bias, that's the put credit spread. Regardless of which direction the price of the stock or index moves, one side is going to win on the move, one side is going to give you a profit on the move, and the other side is still going to benefit from the forgiveness factor that you've built into that trade. So you can still have movement against one side or the other. It doesn't mean that you'll lose on that side. You've got the forgiveness factor plus the knowledge that indexes and stocks cycle multiple times intraday. So here's an example of an iron condor. I'm sticking with SPX, where SPX was trading at 2360 and April week 1. What we did was we went out to April week 4, 3 weeks out, and we opened a 2390, 2395 call spread. Now that has a 30-point forgiveness factor on the call side. At the same time, we opened a 2340, 2335 put spread that has a 20-point forgiveness factor. So we have this sweet spot range of 50 points between the call risk strike and the put risk strike. And as long as SPX remains in that 50-point range, we have the potential of profiting on both sides. That's why this is ideal for an index or a stock that is kind of in a range-bound trading pattern and has been so for a while. We take $1.60 of credit on the calls, right in our $1.20 to $1.80 range guidelines. We take $1.20 of credit on the puts. So combined, we have $2.80 of credit. Now, when we talk about risk on an iron condor, there is not 5 points of risk on both sides, meaning you don't have a total of 10 points of risk on an iron condor. It's impossible for you to lose on both sides at the same time, so you only actually have 5 points of spread risk on an iron condor, but because you have a credit from both the puts and the calls, you actually have a bigger overall credit against the same 5 points of spread risk, which means your overall risk on the trade is significantly less. In this case, we have $2.80 of total credit on both sides, which means that 5 points of spread risk minus the $2.80 of credit equals a $2.20 net risk on this trade. So we have $2.20 of net risk. Remember, the call spread that we gave you as an example here just a minute ago was $3.80 of risk. We can open this iron condor for only $2.20 of risk, which means that any profit that we make on this actually has a higher percentage return for us. So I want to take a look at one other stock here, one of my favorite stocks, Priceline. And when I was looking at Priceline today, I was looking at the fact that Priceline is almost right in the middle of the Bollinger Bands. No strong directional bias one way or the other. It's in the middle of the Bollinger Bands, and the Bollinger Bands have flattened out and are opening almost perfectly sideways. To me, this is a textbook setup for a potential iron condor that is a neutral bias position. If I can get my risk strike on the call spread side outside of the 3 standard deviation Bollinger Band, and if I can get my risk strike outside of the lower Bollinger Bands, on the put side, then basically that means that if the price of the stock moves higher, it's going to encounter the Bollinger Bands, which are going to act a bit like a pinball. It might not push it back immediately, but if I go a little further out, I'm giving myself a huge potential opportunity for profit on both sides, because the price of the stock needs to move beyond the Bollinger Bands on both sides to get to my my risk strike. So let's take a look at the options chain and just quickly see what that would look like for Priceline. PCLN. So the risk strikes, let's see here. Priceline, 3 standard deviation Bollinger Band is at 1806. That's right there, 1806. The lower 2 standard deviation Bollinger Band is 1728. Can I get my risk strikes outside of 1806 and 1728? We're about to find out. I'm going to go out 4 weeks again. I tend to go out 4 weeks on stocks. I tend to go out 2 to 3 weeks on indexes. So let's see here, 1806. So that means the first available strike to me above 1806 is 1810, and I'm looking at 5-point spreads. If I open the 1810, 1815, I'm going to get $2.15. Well, $2.15 is a great credit, and there's nothing really wrong with taking that, but I find that the balance between risk and opportunity is in that $1.20 to $1.80 sweet spot range. So if I go out to the 1820, 1825, I can get $1.60 of credit, or if I go to the 1825, 1830, it looks like it's about $1.25 of credit. All right, so I'm going to say the 1820, I'll take the $1.60. 1820 is my risk strike on the calls, and then I want it to be below 1728 on the puts. So if I go to 1725, gosh, that's $2.15. I'm going to go down to the 1720, and it looks like I can get in for about $1.90. Yeah, it's going to be 1720. So I'm just going to quickly set up an iron condor. I want to sell that spread, and I'm going to choose to sell the 1720 and buy the 1715, and I'm going to sell the 18, I think I said the 1820, and I'm going to buy the 1825. So I'm going to get $3.55 of credit. I might not get filled right at that, but I'm going to work the order. One thing that we do here, especially on the spreads that have a wide bid and ask, we never pay attention to the bid and ask. We're not using the bid and ask at all. If you trade off of the bid and ask, you're losing a lot of money, and you really eliminate a lot of profit opportunity. We work off of the mark, which is the midpoint between the bid and ask. I would put this order in at 355 of credit. If I didn't get filled almost immediately, I would adjust it to 350. I would adjust it to 345. I would continue adjusting it until I get filled, and I'd be adjusting it in 5 or 10 cent increments, because what I'm looking for is the best possible fill on this trade. So that gives you a little idea of what it's like to trade credit spreads, and how a single strategy, your comprehension of a single strategy, will really help to benefit your success. If you focus your attention on really learning a single strategy, and you might choose a different strategy. So what I'm really trying to convey to you here is the concept. I'm using credit spreads as a great example of that. But if you become intimately familiar with how a credit spread performs, and you know that you can use it for a directional bias down, a directional bias up, you know that you can use it for a non-directional position, and you can use it for a variety of stocks or indexes, it just makes trading so much easier. Credit spreads offer opportunities for directional non-biased position, non-directional positions, all based on a single strategy. There are also advanced techniques, which I don't have time to get into tonight, but that we teach at Options Moneymaker. There are advanced techniques that also offer profits from credit spreads by adjusting the spread while you still then end up holding a productive position. We have techniques where we will actually harvest a profit out of the spread using a technique called the SICP, and we harvest a profit out of the spread by widening the spread, and yet we are still then holding a productive spread which may still achieve an additional profit for us as the market cycles. And our experience with the SICP strategy approach to credit spreads is that typically we are earning 20 to 25% return on the capital at risk. Now don't confuse that with your account. This is not 20 to 25% of your total account on a position. This is if I decided to put $1,000 of risk into a particular trade, typically on an average we're earning $200 to $250 of profit on that particular trade. Credit spreads are relatively easy to manage when necessary, and we teach a lot about that. Rolling out and repositions are very, very simple, very simple to manage and adjust when necessary. So the summary of this is you can choose a single strategy. You can leverage the cycles that exist just simply based on the Bollinger Bands. It's a great approach for newer traders, for people who might feel a little overwhelmed with what they're doing. Maybe they haven't had a lot of success in the past. Maybe they dove in and just tried to learn everything they possibly can about trading, and they're overwhelmed and don't really know where to begin. This is a way to keep it simple. This is how we believe traders can learn to trade successfully. We build a forgiveness factor in each trade, as you saw. It helps you be wrong, but potentially be profitable. And we always build time into each position in order to avoid what we refer to as that roller coaster fear and anxiety that can potentially exist in trading. So it's how to simplify your trading and grow bigger profits. So here's what I'd like to offer you. Most presentations that I do, I have some sort of an offer. I would love to have you come and participate in our community if what you heard tonight sounds like it's something that could help you in your mission of being a trader. A lot of traders just look at trading as something that they do. I tend to look at trading as you're actually building a trading business. You're making decisions about how to best generate your revenue and how to manage your expenses. Expenses can be investment and learning. Expenses can be losses. And if you manage your trading business effectively, it can be one of the best businesses in the world. Personally, I love what I do. I love the flexibility I have. My wife and I travel all over the country. We get to come and go, live wherever we want, travel wherever we want, stay as long as we want, and I still trade. I still work. That's my business. Anyway, we have a program called the Profit Builder Program. Profit Builder Program is entirely focused on spread trading, credit spread trading, the SICP advanced trading, and we teach traders how to trade consistently. The Profit Builder Program involves education material. It involves alerts, daily alerts. We have our proprietary app where we send out alerts every time we're placing a trade. We also do a start of day and end of day live session where one of my team members is actually walking through charts, walking through positions, looking at options chains, discussing what actions to take on specific positions. It's kind of a real-time opportunity for people to look over the shoulder of a professional trader and understand how to think like a trader. So I don't really want to charge you any money until you find out whether or not it's something that you would be interested in doing. So my offer to you in the Bigelow community of traders is feel free to sign up for a free 2-week trial. Now, you've got to use the link that is on the screen here. It's optionsmoneymaker.com/pbfree. But if you use that link, we're going to invite you into our community, in the Profit Builder community, at no charge, no obligation. You don't have to give us a credit card. You don't have to give us anything in advance. If you sign up and you go through 2 weeks and you don't really think that it's something that would fit into your trading, then I would wish you well and hope you are very successful as a trader. If it's something that you would like to sign up for, then you certainly would have an opportunity to join our community, and then at that point we'd be happy to provide a lot of education materials to you. The free 2-week trial is access to daily alerts and access to the start of day and end of day live trading rooms that we offer, as well as during that 2-week trial there will be one Q&A session. We do a Q&A session for our entire community of traders every other Wednesday, so you would hit one of those Q&A sessions and you can come in and ask questions, and you can come in and listen to other traders who are asking questions and seeking clarification on their own understanding of how to build their trading business. So I'd like to see if there are any questions out there. Let me see if I can pull this up here. Okay, let's see here. Hang on just a second. Okay. Just going back looking to see if there are any questions after we started here. All right. Oh, that's great to hear, Terry. Terry says, thanks, Mark. Took the program a number of months ago. Continue to use the strategy. Excellent. Don's asking, how much does it cost after the trial? It's $295 for 3 payments, and then we have, for the Bigelow community, we have a special offer where if you sign up at the end of the 2-week free trial, it's $295, 3 payments over 3 months, and then we give you free access for an additional 3 months to all of the live trading, start of day live trading, end of day live trading, alerts, and the Q&A sessions. I think the first thing, though, is you have to figure out whether or not what we do is going to work for your type of trading. And we've tried to price our programs also to a point where we know what people can make trading a simple 2 or 3 contracts and the number of trades that it would take in order to have a return on your investment. I look at this like a business person. I want to be successful if I was an individual trader just running my own trading business. So I've tried to think of it that way too. What's the minimum liquidity on option strikes that you trade? We don't have a specific number, Michael, but we're comfortable with the stocks and indexes we trade. Indexes have good liquidity to them. We never have an issue on that. If we're looking at an individual strike on a stock like ISRG or Priceline that has very, very low open interest or volume, then we might choose a different strike, look to a different stock if there's a nice setup there. Joe is asking, how well will this work for an options novice? Well, this program was designed specifically for someone who really wants to become acquainted with options trading. If you sign up for the program after the 2-week free trial, one of the things that we give you is a trader's guide to option basics. I mean, we start with just the basics, defining expirations and calls and puts and strikes, etc. You also get a trader's guide to credit spreads, and you get about 6 hours of on-demand video content which walks you through a more expanded version of what I shared with you tonight. So I personally think it works very well, Joe. kind of spread would you do for a high price stock for which you are very bullish to make a big move up? I would be opening, using what we talked about tonight, I would be opening a put credit spread where I'd be selling to open a put and leaving myself a forgiveness factor, and I'd be buying to open a put that is further away from the current price of the stock than the one that I'm selling to open. Lynn's making a comment, and very valid. On most of the stop options, there seems to be, stock options seems to be a huge spread between bid and ask, and that's exactly why I don't trade bid and ask. We teach in our community to focus on the mark. The mark is the midpoint between the bid and the ask. If you're trading the bid and the ask, you're not going to make much money. In fact, a lot of the trades that we place, if we were trading the bid and ask, we wouldn't make any money at all. It wouldn't even be worth our time. So the mark, the midpoint between the bid and the ask, and learning how to work that mark is really the key there to minimize the width between bid and ask and actually create your own natural spread. Let's see. Will you actually take the trades on Priceline and SPX, or did you use them just for teaching? So the SPX that I showed you in the example on the slide, that's a trade that we had that I'm just showing you as an example. The Priceline trade is a trade I may actually set up tomorrow. I was actually looking at the market today, which is why I wanted to show it to you. And the ISRG trade that I actually showed you is a trade that we opened yesterday based on the Bollinger Band snap and new all-time high. So the ISRG example I gave you is a trade that we are actively in. Priceline is a trade that I'm considering, but I have not actually opened yet. Do you go into adjustments if the trades go against you? Absolutely. That is one of the keys to being successful trading credit spreads. We teach you how to adjust the trade. Adjust could mean just simply reposition. Adjust could mean roll out. We have a variety of things that we teach, but we try to keep it relatively simple. And the key to being successful and maintaining some level of simplicity is starting with a proper entry of the trade, proper placement of the strikes, and increasing the probability that that trade is going to be successful. All of this is not guaranteed. All of this is about stacking the deck in your favor and increasing the likelihood that that trade is going to be successful. And you will have some losing trades. You will have some trades that don't work out. But in our Profit Builder program, we focus on building your core knowledge and understanding. And one other thing I want to share here, and then I'll see if there are any last questions and then wrap it up. We're such big believers that risk management is the #1 essential for every trader, that in our Profit Builder program, we strongly recommend, although we cannot control, we recommend that if you sign up for the Profit Builder program, that you start in your personal account with no more than $5,000 of risk capital. Now, I think personally you need at least $5,000 to be able to trade successfully and have enough flexibility. But I frequently hear from people that will tell me I have 6 figures, you know, how much should I scale your Profit Builder trades that you send out via alerts? And I go, I wouldn't scale them at all. You have yet demonstrated that you really are comfortable with your understanding. I don't want you to risk more than $5,000. If you come to trading with a fixed amount that you are willing to put at risk, you most likely will be successful because you're not going to constantly be worried about whether or not you're going to lose money. And if you combine that with focusing first on trading to learn, and second, after you've learned the basics, then trade to earn, you're going to increase the likelihood that you will be a successful trader. So that's why I want to offer you the free trial. I've been through a lot of programs myself over 30 years, and sometimes I'm taking a risk or taking a chance, a calculated risk that I'm willing to take when I pay money for a program, but I really like to see how it works. You know, you're not going to learn everything you need to during 2 weeks, but you're going to get a good idea of how we teach, how confident you are that you'll understand what we're doing once you get into the material, and whether or not our community is a group that you feel like you want to belong to and will add value to your overall trading business. So again, I invite you to come and spend 2 weeks with us. If you love us, great. that's what we hope will happen. If it doesn't work out for you, there's no love lost for me. We'll wish you well and hope you are very, very, very successful in your own personal trading. What's the ongoing monthly cost after the 2-week free period? So it's $295 in 3 payments for the first 3 months, and then after that, it's $129.95 a month. But the Bigelow community is being offered that the second period of 3 months is the $129.95 per month is being waived. So basically, you can participate for 6 months by paying $295 per month for the first 3 months, and then there's no payment for the months 4, months 5, and months 6. And then after that, it's $129.95 a month. James is asking, is the 10% profit after the broker fee? No, James, here's the way I look at that. I set my profit target at 10% of the gross risk. Gross risk is 5 points. 10% is 50 cents. The reality is my true net risk is less than that. So in the first example I gave you, I only have true net risk of 38 cents. I'm sorry, of $3.80. So if I take 50 cents as a profit against my true net risk of $3.80, my percentage return is much higher. So then you take broker's fees, commissions, and everything out of that, and you still have generally better than a 10% return. But that's a way that we just simplify it. We just set our exit target at 10% of the gross. Let's just see here if I can grab a couple more questions. Thank you for that, Don. I used to teach some large groups of people in person, yeah, I appreciate you saying that. Don just says just buying at the mark or near was worth the entire course that he attended. But thank you, Don, and thank you for being here. Does the free trial membership get the same access to all the materials as a regular membership? It gets access to the start of day and end of day trading rooms, the live sessions. It gets access to any trade alerts that we send out during the 2 weeks. It gets access to our Q&A session that occurs during that 2-week period. It does not get access to all of the written content, all of the education videos and the trader's guides to basics and credit spreads. So all of that education content is what you get when you sign up for the program. What we're trying to do with a free 2-week trial is to kind of give you an idea of how we teach people and see whether or not it works for you. What are the hours of the 2 weeks? All right, so we have a start of day live trading session that starts when market opens at 9:30 Eastern, and generally that lasts for half hour, maybe 45 minutes. And then the end of day opens at 3 p.m. Eastern and will generally last half hour to an hour, and there are opportunities to ask questions in those sessions. It may not work for everybody, that schedule may not work, but even if you sign up for the 2 free week trial, you're going to get the recordings of those start of day and end of day sessions. They are recorded, so if you can't attend them live, we're going to send them to you, so you still get the benefit of the knowledge and training that's going on during that time period. Where do you exit if the trade's going against you? We talk about all that, but very simply, we would more than likely roll the position out. We would assess the chart, determine whether or not we still like the directional bias that the trade has, and we may just roll out to give ourselves a bit more time. The Wednesday Q&A session is at 7 p.m. Eastern, generally 7 to 9 p.m. Eastern. Bob's saying, if I can't sign up now for the free trial, can I get the same deal if I sign up a month from now? Bob, if you send me an email and tell me that you're part of Steve's community of traders, yes, I'll help you out with that. And last question goes to Matthew. Would you review the pricing again? All right, so there's a 2-week period where you're going to have a free access to the portions of the program that I shared with you. After that, it's 3 payments of $295, and those are spread over 3 months. So $295 for the first month, $295 for the second, and $295 for the third. The reason we priced it that way, we used to have kind of an all-in price that you pay up front, but I'd really like to help you earn that $295 each month before you have to pay it. Well, the first month you have to pay it, but then after that, help you earn before you have to pay it. And then after the third month, the Bigelow organization community, the community is being offered 3 additional months free of all of the access to the live sessions as well as alerts. So basically, you're getting 6 months of participation in our community for the 3 payments of $295. All right, those are all the questions I see. So let me just say once again, thank you very much for having me. It's really a pleasure to interact with traders and respond to questions, and I know you're interested, and Steve's organization is a great organization, very, very well respected, and I just appreciate, consider it a privilege to be here tonight and be able to talk to you a little bit about what we do. I love what I do. I love trading. I love the flexibility I have, and I come from a family of educators. My father was a college professor. My mother taught school, and it's just kind of ingrained in me that if I have knowledge that can help and benefit others, and I can help them be better at what they do, that's what I love to do, and that's why I started teaching other traders how to trade. So thank you so much for having me here, and I hope to meet some of you in my community.
Thank you very much, Mark. Very good stuff, everybody. For the price, which is free, at least take a look. And Mark's got a very good reputation, and we got people already in our chat rooms that have just give him good acclaim for the way he teaches and makes everything much more simple to understand. So with that, thank you, Mark, and thank you, everybody, for showing up. We'll see you all in the chat rooms.